Welcome to the inaugural Value Town Fund Show, episode 001, Activision Blizzard. So I've got $480 burning a hole in my pocket thanks to your contributions before I even had a single show with Patreon. Thank you for subscribing, for being a Patreon, and, click the link below if you like this kind of content. It directly funds the show. Every single dollar that I get from Patreon will go into this kind of show and investing in the stocks that I review, either long or short. It could be a buy or a sell. This particular stock was voted on by Twitch, and I'm glad that they picked it because I have been a consumer of Activision Blizzard, specifically Blizzard, for over 20 years. Starting with Warcraft 1 and Warcraft 2, I played through so many Blizzard games. I even stream their games. I run a YouTube channel, which features mostly Blizzard games. So, as Warren Buffett would say, Activision Blizzard clearly lies in my circle of competence. It's a stock that I understand pretty well, and as Peter Lynch would say, he encourages investing in stocks that you know. But of course, you have to do your due diligence as well. And I'm going to showcase how I do my due diligence in stock research. There's a cool website called Finbox. Link below if you'd like to look into it yourself. Analysis on companies has never been quite as easy as in today's age. As even Buffett says, the individual investor has so many more tools available to them. It's Activision Blizzard, ticker ATVI, a United States-based company in the sector of communication services in the industry of entertainment. Most of you probably know this already, but I'm just going through the motions when we actually get a company that we have no idea about. And then I scroll down. What does Activision Blizzard do? They are a global company, 3 segments: Activision Publishing, Blizzard Entertainment, and King Digital Entertainment. I would imagine from my audience you know quite a lot about Blizzard, but you don't know that much about Activision necessarily, and you certainly really don't know about what this King Digital is. They make games for PCs, video games, mobile devices. They make their money through subscriptions, through selling the games, through in-game sales, and by licensing software to third-party or related parties. That's in particular China. The company also maintains Battle.net, a digital distributor of content. It also operates esports leagues and offers advertising. It also provides warehousing, logistics, and sales distribution services to third-party publishers. Key franchises are Call of Duty, that's on the Activision side, World of Warcraft on the Blizzard side, Candy Crush on the King side, and there's also Diablo, Hearthstone, and Overwatch. StarCraft not important enough to mention. So that's Activision Blizzard. We look at the price history here, and indeed Activision Blizzard has done really well for you if you owned it over the 10 years, increasing its value by more than 7 times, which is far beyond what you would expect from a 10-year holding. This is beating the S&P 500 by a lot. But of course, past performance does not guarantee future results. One of the things I like looking at most when I see these charts is I like to look at sudden spikes up or sudden declines, and the most notable of which happened around here. There was a minus 50% correction in a very short amount of time. So certainly we'd like to know, why did that happen? Now, it's always difficult to pinpoint down exactly the reason for stock movements happening, but 2 major things occurred during this time period. Number 1, and I was actually part of this, there was BlizzCon 2018, which happens on November 3rd. During BlizzCon, there was a famous kerfuffle where a Blizzard developer commented when pitching Diablo Immortal, "Do you not have phones?"
Is there any plans to make this playable on PC, or is this strictly mobile forever?
The current plan is to be on mobile, both Android and iOS. We don't have any plans at the moment to do PC. Do you guys not have phones?
Yeah, you guys all have phones, right?
And this was not well received by the Diablo community, who was very much looking forward to Diablo 4, and instead got the, we're not releasing this on PC, by the way. That might be the cause, might be contributor to the cause. Another potential cause is that the Q3 earnings report was released November 8th, and the forward guidance looked very grim. So scrolling down, here's some important metrics. Activision Blizzard pays a small dividend. I usually don't care about this metric at all. PE ratio is 30.6x. PE ratio is how many dollars are you paying per dollar earnings of the company. And it turns out you're paying $30 per dollar that the company makes per year. Is that high? Well, yes, historically it is high. However, compared to the S&P 500, which is currently trading at 46 PE as of July 15th, it is a little bit under. If you're watching this from the future, we're living in historical times where bond yields are historically low, so that is causing price earnings ratios to acceptably be high and theoretically not be in a bubble. Thanks to Finbox, looking at the financials is pretty easy. You can look at the financials a lot of different places, but I happen to like this site. First thing, income statement. I look at the revenue. Are we making more money every year? Yes, that's good. Are we profiting more money each year? Because revenue is just, getting more money through sales. Yes, we are also growing. In fact, last year looked really good. That's really good. Looking at the balance sheet, how does our assets look compared to our debt? Holy cow, we have $8.6 billion in the bank, actual cash. So our assets are $23 billion for Activision Blizzard, $8.6 billion in cash, and total liabilities, $8 billion. So essentially, this company has enough cash on hand to pay down the liabilities. That's exceptionally good. And finally, we take a quick look at the cash flow statement. How are cash from operations looking? Growing each year. Great. You can quickly see that the company does not actually require many capital expenditures because this is a company that produces software. Looking at the valuations ratios tab, one of the ratios I like looking at is EV to EBITDA. That is essentially the enterprise value multiple of this company. It indicates how much that the company is worth. That's EV, enterprise value, relative to income, which is earnings before interest, tax, depreciation, and amortization. This has risen over the past years to an all-time high of 23 times. This implies that the company is doing pretty well currently. It used to be at the low of 7 or 6 times. When you look at a price to earnings ratio, this is telling a slightly different thing. This is how much people are willing to pay the price of a stock in general per earnings that the company is making. There was a high amount of 61 times back in 2018, currently around 32x, or rather when I looked at the current, it was 30 times. Historically, this has been as low as 10 times. So you could look at this number and think, that's kind of high. But again, I believe right now, most companies do have a high PE ratio due to the unique low interest environment that we live on. Now you're going to notice that I did all of this before even opening up a spreadsheet and before trying to even figure out fair value. And I'm still not going to open a spreadsheet yet. And this is actually a critique that I have of a lot of people who just rush to the analysis too quickly. You have to understand the company first. So let's take a look at the annual report 2020. The most recent annual report that the company publishes is a good place to look for all the information about a company. Yes, it is 136 pages, which is why if you actually want to do this stuff, I think you should have a strong interest in the company and or actual finance. There's a lot of good information in this annual report. However, I'm going to only point out the really exceptionally important things that I found. Realization number 1. Activision Blizzard for the years ended December 31st, 2020, 2019, and 2018. The top 3 franchises, Call of Duty for Activision, Candy Crush for King, and World of Warcraft for Blizzard, collectively accounted for 76%, 67%, and 58% of our net revenues. No other franchise comprised 10% or more of our net revenues in those periods. I find this really important because that means this company relies a lot on those 3 titles. And if anything happens to those 3 titles, that's really bad for the company. The other thing that I thought was particularly important was this page 95 out of 136. This is comparing Activision, Blizzard, and King's revenue and income over 3 years. I found this really, really useful. So, in the most recent year, Activision killed it, making nearly $4 billion on revenues, compared to Blizzard's slightly under $2 billion and King's slightly over $2 billion. You may be surprised if you've never read a financial statement that Blizzard, the entire company, is making less money than King, who makes most of their money off of one game called Candy Crush. So that's to put things into perspective. Looking at this, I think it's roughly right to say at the moment, Activision is about 50% of the company of Activision Blizzard. Blizzard is about 25% and King is about 25%. In 2018, this wasn't necessarily the case, where you can notice that the incomes of these 3 companies are much closer to each other. Not quite a third each, but closer to that. Where you can note that Activision also has a generally higher profit margin. Blizzard has the worst profit margin because it takes a lot of money to develop new games. And King is actually just really steady. If you look at these 3 revenues and incomes, King is really, really steady. Along with the most recent annual report, it's really important to look at the quarterly report. Activision Blizzard happens to have a cool little investor slideshow, which is a lot of fun to look at, and only 14 pages. The highlights, where, spoiler, they have better than expected and record Q1 financial results. That's good until you review every single quarterly report that they've made in the last 5 years, and it is always better than expected. Does the company usually lowball their earnings estimate and revenues estimate? For Activision Blizzard, the answer is yes. You get their set of games and what each company has been doing. Activision is a game that's all about Call of Duty. I learned through looking at this report that this Warzone thing was a very big deal, and mobile was also a very big deal. Blizzard I happen to know about. Shadowlands came out. That was a big deal. And Diablo 2 Resurrected and Diablo Immortal is coming out, and that looks promising. King, I was surprised to find, did outstandingly. And this is important. They delivered 70% year-over-year growth in advertising. So that means that advertising is picking up. King has just been a very stable provider of income. So King's revenues ended up being $609 million, and it made $203 million, which it's hard to quantify how good that is until you compare it with the history. This was a big deal. King has this amazing target demographic, and I actually had to see it for myself. It's important to try out the company's products. So I downloaded Candy Crush and I played it, and it was actually kind of fun. Candy Crush has been a big deal for years, which is exceptional, and it doesn't look like it's going to stop anytime soon. So these are graphs that you aren't actually going to find anywhere on the internet other than here. This is a better understanding of a company by plotting each of the 3 companies' revenues. I pulled this by looking at every single quarterly report from Q4 2016 until Q1 2021 today. You got the revenue of Activision, you got the revenue of Blizzard, you got the revenue of King, and you have their profit. The general note is that Activision has been doing really well, notably in Q2 2020. That's when the COVID hit, and a lot of people started staying indoors. The free-to-play game Warzone took off during this time, even though it was released earlier in 2019. This phenomenon has helped boost Activision's revenue by a lot. You'll even note that the Q1 2021 revenue is substantially higher than the Q1 2020 revenue, indicating that this might be a lasting effect. King is just really stable. It makes money every single quarter. It doesn't matter what quarter it is, with notable improvement in the final quarter. And Blizzard, poor Blizzard, it's actually, when you look at it, slightly on the decline. When you look at the profits, it becomes a little bit more obvious that, in general, Activision makes all of their money in Q4. Why? Because without fail, every single Q4, they release a new Call of Duty game. In every quarter, other than Q4, Activision is outperformed by Blizzard and King. However, recently, Activision has been outperforming Blizzard, even not on Q4, and King. So this is a really good sign for Activision. Next up, I think it's really important to look at the most recent earnings call. The earnings call is where the officers of Activision Blizzard, or the company you're looking at, tout their company. Read this knowing that this is the company's officers bragging about their company. In the last 20 years, we've delivered 21% compound rate of return as compared to the S&P 500, which delivered 8%. $1,000 invested in Activision in 2001 would be worth over $45,000 today, as compared to $4,900 in the S&P 500. So, in general, I like low-cost index funds, and the S&P 500 is essentially something you can replicate through a low-cost index fund. And 20 years to 5x your money, that's pretty good. But you know what's even better? 20 years to 45x your money. Now, here's the thing. Past performance does not indicate future results. Activision Blizzard was a much smaller company back then, and it happened to make a lot of good games. And game companies are really defined by the quality of games that they make. I will give you the spoiler that it's probably a reason why Mr. Kotick here, CEO and director of Activision Blizzard, decided to say in the last 20 years, we've delivered great rates of returns. It turns out that over the last 5 years, it has not been as impressive. Now, there's a lot of good stuff here about what they're doing now, but I've already covered most of it. But it really did emphasize that Warzone was a really big deal, and they know that. Also, mobile was a big deal for Call of Duty. They're clearly really excited about this year's premium Call of Duty release, and it makes sense. I think that they are onto a really good strategy here with Call of Duty Warzone. Call of Duty Warzone has amplified the performance of past Call of Duties. By the way, and I did some research on this, Call of Duty Warzone took off huge. It released in 2019, but it really came into stride thanks to COVID forcing everyone to shut down. This here is a Twitch tracker of games played over time, and you can see when lockdowns occurred. This has actually pulled people from Fortnite as well. You would expect Fortnite to grow a lot during a lockdown, and it did, but Fortnite has, as of late, decreased in popularity. Call of Duty Warzone is the #1 battle royale as streamed on Twitch. And here's Apex Legends. What people may not entirely realize is that Call of Duty Warzone also drives people to buy the other Call of Duty games, because apparently there's this really cool connection, cool for the company, where if you play Call of Duty, you level up weapons, which you can use in Warzone. Fascinating business model. And I can see why they're very excited for the Call of Duty release, which is going to happen December 2021. Every single Q4 people buy the Call of Duty. It's tradition. Also, World of Warcraft Shadowlands happened. Burning Crusade Classic is going to come out. This is expected to bring back some people who were subbed to Classic. Diablo franchise is exciting for Blizzard. This year, Diablo 2 Resurrected is coming out. There's actually a date for that. And also, this year, expected, is Diablo Immortal. How well is Diablo Immortal going to be? It's kind of the big question mark right now, but I think it has a surprisingly decent chance, especially in the Chinese market. Now, Activision Blizzard is one of the companies kind enough to actually give you guidance. Not all the companies do this. So Q2, Activision Blizzard is telling you, they expect revenues of $2.14 billion, and they expect an operating margin of 39%. Earnings per share, 81 cents. And they also give the guidance for 2021, $8.37 billion, and operating margin 36%, and earnings per share of $2.91. It's worth mentioning that they have risen this guidance. It was lower before. So they feel better about their results. Additionally, something that looks promising from this earnings call letter is that Activision Blizzard is increasing its hiring, which means they're increasing the amount of money that they're investing in order to presumably put out cool new games. And that's good for gaming companies. Only now that we have a decent understanding of this company, and I've been taking notes on a spreadsheet off to the side, am I ready to do the discounted cash flow analysis, which is how I value companies. My process for building a spreadsheet right now involves going to Finbox and then exporting their 5-year discounted cash flow EBITDA exit spreadsheet and the 10-year discounted cash flow growth exit. So that was easy, right? All I had to do was export it. On July 16th, the Activision Blizzard stock was worth $92.38, and the fair value, according to Finbox, when you directly export it with the pre-filled in numbers, is $147.95, representing an upside of 61.2%. Amazing! Obviously, I should buy, right? Well, hold on. So there's a few automatic adjustments I make onto every single Finbox discounted cash flow analysis spreadsheet. The first thing I do is I paste in some calculations in order to calculate a discounted rate. That is the rate that you're discounting all the future cash flows in, because the way that you calculate a company using a discounted cash flow analysis is you calculate all the future cash flows and then you discount them back to the present day, because cash in the future is worth less than cash now. So in order to figure out the value of a company, you need to get all of the money that you're making in the future and then count that as if it were present money. Now, how much do you discount that by? And that is done using the capital asset pricing model, where the discount rate should be the risk-free rate of interest plus beta times the equity risk premium, which is the amount that an investor needs to get an additional return past a 10-year treasury bond, or the risk-free rate. By going to Damodaran's betas by sector page, I note that the entertainment beta is currently 0.79 for a company with no debt, which is what this company effectively is. Furthermore, to confirm this beta amount, Finbox has the 1-year, 2-year, and 5-year beta amount of Activision Blizzard. This beta has happened to change quite significantly, and it looks like 0.8 lies somewhere in this range, so I'm going to use 0.8. 10-year treasury bond on July 16th was 1.3%. Because I am currently expecting this rate to go up over the 5-year period of time, I've added 1% on top of that. The current equity risk premium that investors are generally accepting over the 10-year treasury bond rate is 4.31%. And additionally, since this company, Blizzard, does its business worldwide, I'm adding an additional 0.5% on top of that. The calculation using the CAPM capital asset pricing model seems to be 6.15%, meaning by default, you're expecting this vanilla entertainment company to return 6.15% on your investment every year. So I take this number and I plug it in, replacing the current selected discount rate, which Finbox has provided as 6.8%, and that is going to make it 6.15%. Note that because I'm accepting a lower rate of return, that is going to move the stock price, or the fair value price, up from 148 to 151, showing the significance of adjusting a discount rate. Other adjustments I'm going to make on this spreadsheet include changing the selected tax assumption. I think last year's taxes are probably more accurate than a 10% selected tax assumption. By increasing the tax rate, that's going to make the implied fair value go down by a little bit. A major part of the calculation of the value of this company is going to be the EBITDA exit multiple. And the way that the 5-year discounted cash flow model with the EBITDA exit works is that you count up the discounted cash flows of the 5 years, and then you add in a big chunk of money at the end, which simulates selling the business at a multiple of the EBITDA value, which is earnings before income, tax, depreciation, and amortization. Now, what should this number be? Well, this is a really important number, so the way to look at it is through similar companies. Scrolling down, we can see historically, Activision Blizzard has traded for anywhere between 15 and 23.4 times EBITDA. And we can see that recently, the main competitors, EA and Take-Two Interactive Software, have been trading at 29.7 and 21.3 times. Because I expect this multiple to decrease in the future, and also in order to have a more sane valuation, I'm going to choose a little bit more of a conservative multiple. The 5-year median might be acceptable, but looking further back, it has been even lower than this in the past. I'm going to choose 17x. Another thing I like to do in order to simplify this particular spreadsheet is when there is no other income, I generally delete this row. And similarly, I delete those 2 rows on the bottom of key projections. This cleans up this spreadsheet. So after all those default changes, the fair value has climbed to a massive 180. But I haven't made the most important changes. Those are just the changes I make to every single spreadsheet. Now it's going to the numbers. Now, the big thing to look at is, are there any crazy numbers being used here? And yes, there are. Usually, the big offenders, when you just take them straight from Finbox, are going to be the years ending on the 4th year and the 5th year. Why? That's because Finbox gets their revenues and earnings through the average of analyst forecasting. So in the first 3 years, there's a good amount of analysts, so when you take the average of all the analysts, you're going to get some very similar numbers. However, in the 4th and 5th year, you can see that the number of analysts drops down a lot. So because the 4th and 5th year have so much fewer of analysts, that can really adjust the numbers here. Furthermore, for whatever reason, this EBITDA percentage of revenue has been drastically overinflated. And this is where all of the calculations I've made given the earnings reports comes into play. When I calculated EBITDA percentage of revenue by year, I looked at 2020 and it seemed to come up 37.4%, 32% in 2019, 33% in 2018, 32% 2017. Hard to say if there's going to be the constant increased EBITDA percentage of revenue. I attribute this mostly due to the Activision operating margin being higher. So I think perhaps the higher EBITDA amount can be used. So first thing I'm going to do is just replace all of these percentage of EBITDA margin by straight 37%. Furthermore, the DA margin, debt margin, and the CapEx margin These numbers are completely wild. I'm just going to replace all of these with a straight 1%. Very minor part of this particular company. And then, with these in tow, you can simply just calculate the EBITDA by multiplying the revenue by this percentage, going across the entire row, and similarly for debt and amortization and capital expenditures. So those have been adjusted. Now the big number to focus on, year-over-year revenue growth. So the reason why I focus so much on the year of 2021 is because that is the number that is most clear to look at, the easiest to estimate, since you have the data adjacent to it. I've made assumptions based on previous history that generally Q1 is pretty poor for most companies out there. So there's 3 different companies. Activision will grow their revenues by 10% every year, every quarter rather, on top of each other. And furthermore, I believe that the Call of Duty Vanguard release will provide a 10% more revenue total for Q4 than the quarter before that. This generally follows the trend of previous years. For King, reading their quarterly report provided the backing that it seemed like Q1 2021's revenue might have been raised due to advertising revenue increases. Now, if that holds, then generally advertising revenues tend to go up from Q1. I've decided that even though this is King's highest revenue quarter so far, that I'm willing to say that King will make the same amount of revenue in Q2, 3, and 4, which traditionally King has made about the same amount every quarter. The only question is, should I be taking the highest quarter's revenue and using it for all of the rest of the quarters? I think that's reasonable enough given the story. And it's really important to craft a story behind all of this, that King has permanently increased revenue due to being better at advertising. And finally, Blizzard is actually the most volatile of these. I've decided that between Q1 and Q2, that the revenue remained the same. That's despite WoW Burning Crusade being released for Classic. This is going to make a few more subscribers come back. However, it's going to be compensated by the usual, well, Shadowlands is old news now, some people are going to unsubscribe. So there's generally an outflow of subscriptions following every expansion period. Now here's the interesting projections, because these particular games, like Call of Duty Vanguard, kind of easy to predict given that Call of Duty Cold War, Call of Duty Modern, Call of Duty Black Ops, Call of Duty World War II, very similar year-over-year increases. But this is a bit of uncharted territory, and this is where having the area of expertise, a circle of competence, as Warren Buffett would say, of gaming comes into play. We might have a little bit of a guess on how well Diablo 2 Resurrected will do and how well Diablo 2 Immortal will do. And sure, any analyst can come up with this. However, in this case, with Diablo 2 Resurrected, I've made the assumption that it's going to sell 1/10 as well as Diablo 3 during the first year. Going off the data I could find, Diablo 3 sold 15 million copies during the first year. So 10% of that would be 1.5 million copies. Given the price tag of $40 for Diablo Resurrected, you calculate that that's going to be a $60 million increase of revenue for Blizzard during Q3, when Diablo 2 Resurrected is slated to come out. So I simply added 60 million onto the 483. That's 543 million. However, additionally, I have generously accounted for the gradual disappearance of World of Warcraft subscriptions. Diablo 2 Immortal is a lot more tricky to evaluate. I've decided to be pretty conservative and just basically think that it won't do much. Yes, this is an increase of 40 million on Q3. However, every single Blizzard Q4 has been better than Q3 just because It's the quarter 4 area. That's where Black Friday and Christmas comes around. People like spending a lot more in quarter 4. This is a seasonal company. From this perspective, even if Immortal didn't come out, the revenue would probably increase by that much. This is a very, very conservative estimate, utilizing almost 0 credit towards Immortal, purely because I don't really know how well Immortal will do, which is a very conservative estimate, which means there's a lot of upside if Immortal is actually a huge success, which is quite possible. Using all of these revenue streams, from Activision, from Blizzard, and from King, I get a total of $9.2 billion, add in miscellaneous from past history of non-reportable segments, which I just lazily copied from 2020. I wasn't entirely sure what numbers to use, but minor part of the business anyways. Looks like $9.7 billion in revenue expected for 2021. So here's where I start multiple tabs in my Google spreadsheets. There's an analyst tab, where I just simply use the analyst provided numbers, and I use saner growth rates for 2023, 2024, and 2025 when those analysts have less agreement, or there are less analysts covering them. But for the neutral perspective, this is where I'm going to use my own numbers, where I'm going to break apart from analyst predictions. I've decided to use that number. I'm rounding that up to 9.8 billion for the year of 2021. That's how much revenue I think they'll make, which is more than the analyst expectation. Then, for the next year, it's a very standard multiplying it by the year-over-year revenue growth using historical averages. But then 2023 is a very interesting spot. So normally, under the analyst growth rate, I've said 2023, we'll call it 6% revenue growth. However, on top of 6% revenue growth, I've decided to add $1 billion on top of that. So how can I just add $1 billion onto an additional 6% growth here? Well, that's where valuation is an art, and this is where having the circle of competence be gaming comes into play. Under my general research, I have no inside information, by the way, I have deduced that Diablo 4 is going to come out somewhere in the year of 2023. Furthermore, I've made the assumption that it's going to sell 10 million copies in year 1. And I also think that when it's 2023, people are going to be fine paying $70 for Diablo 4. So that would mean $70 times 10 million copies, which is a guess based off of Diablo 3 selling 15 million copies in year 1. That's going to be $700 million. You take into account that there's going to be potential expansion packs. You take into account that there's going to be collector's editions. You also take into account a bit that, well, sometimes it's not going to sell for $70 because maybe it'll be on sale. Maybe selling to other countries, you'll get a lower price. All in all, I've decided to just say $1 billion for that, which is based on an overall story that it's going to sell a little bit less well than Diablo 3, which is conservative, I think. So off of that, I have given an immediate one-time $1 billion increase in revenue for Activision Blizzard. And then 2024 and 2025 are pretty straightforward. It is the classic basing off of the general growth rate of revenue, slowly decreasing over time, 6% in 2023, 5% 2024, 4% 2025. However, it was a little bit tricky to figure out 2024's growth rate because I had given 2023 a $1 billion revenue increase. So what I did was calculate the base value as if I had just gone 6% and then 5%, and then I used that number for the revenue of 2024. And when all that was entered, the fair value is coming up at $106.15. Now that's not the only one I did though, because it's good to consider all the situations of Activision Blizzard. This happens to be my personal belief on what is most likely to occur, but all valuations have some percentage chance of different stories occurring. So to talk through this particular story, and it's important that all of your valuations have a story, what does this say? This story states that I believe Activision is doing really well, the Activision company of Activision Blizzard, I believe that Warzone is feeling an increased desire for Call of Duty games, and quarter 2 and quarter 3 are just going to continuously actually provide extra revenue as opposed to decreased revenue, like sharp decreases post-game releases. I think there's going to constantly be purchases in this free-to-play game archetype, and that it's going to drive additional sales for their new game, Call of Duty Vanguard, because when you have this Warzone mechanic, more people are going to be interested in playing the new Call of Duty. Because some of the progression from Call of Duty Vanguard will presumably go towards Warzone, similar to how Cold War and Modern Warfare are working. So Activision's doing great, and I think will continue to do great with this Call of Duty Modern and Call of Duty Mobile. Blizzard, I think, will continue to trend as World of Warcraft decreases in popularity, but the new games of Diablo 2 Resurrected and Diablo 2 Immortal could do really well, and notably I think Diablo 4 will do really well when it comes out. And that's still providing, I think, fairly conservative estimates for how well they'll do. One could even say Diablo 4 has a big chance of exceeding Diablo 3 by a good amount because there's a buildup of hype through the releases of Diablo 2 Resurrected and Diablo 2 Immortal. Diablo 2 Immortal possibly opening up a far greater market in China because the Chinese love their mobile games. And King does their thing. If they just keep up the good work, then that's providing a very steady revenue stream towards Activision Blizzard. So that's my neutral story. The analyst story is a story where I just use the analyst numbers and I don't have my own story. That number provides a fair value of $95.68. The pessimistic fair value is if I hilariously use Activision Blizzard's predicted earnings in their earnings reports where they always lowball the estimates. And I just pretty much projected out their lowball estimates. Of course, the year where they actually launched Diablo 4, I'm sure they'll have a higher growth estimate, but I've just decided to start discounting from 3.5% growth, which is really grim indeed. Consider this essentially the worst case scenario where Activision Blizzard falls out of popularity and their future games are all met with middling receival. For the neutral EBITDA exit multiple, I used 18x. For the analyst EBITDA exit multiple, I used 17x. For the pessimistic exit multiple, I used 15x. Additionally, since Activision Blizzard is a long-lasting company with a lot of history, I believed it was fine to use a 10-year discounted cash flow model with a growth exit on it. This is a methodology where you take the discounted cash flows over the next 10 years, and then during the final year, instead of selling the company at a multiple, you just assume that the company will continue to grow forever at the final perpetuity growth rate, which I said to be 2%, which is the guess for what the US economy will grow at. So under these assumptions, same growth rates for the first 5 years with a slow but sure decline to the perpetuity growth rate of 2%. This provides a fair value of $102. So which story is correct? In reality, there's a percentage chance of any of those worlds happening. So I've assigned my belief of how much weight, how likely it is for each of those scenarios to happen. And I said about a 40-55% chance in all of what I thought happening to occur. 10% chance of the apocalypse happening for Activision Blizzard. And then analysts are paid to analyze companies. I decided to give their weight 35%. Also worth noting is that, so there's a difference between the analyst discounted cash flow method and the actual number that the analysts say is the target price. To find the analyst price target, I used tip ranks. Currently, the analyst price target is $118.28 across 18 different analysts, and they all say you should buy the stock. Now, $118 as the price target is a bit different than the price targets that I've been using. My price targets say what the company should be worth right now. However, their price target is what it should be in a year. So in order to figure out what they think it should be worth right now, I discounted their $118 next year back to the present day, which is essentially dividing by a year. It's like discounting their predicted price target by 1 year to figure out what they think it's worth right now. And right now, they're generally thinking it's worth 111, which is actually even higher than my prediction. So through calculating the expected value of all of those outcomes, I find that the target price for Activision Blizzard should be $101.59. As it is currently $92.38, there's an upside of approximately 10% for it right now, which is to say that my best guess is this company is 10% undervalued. So I'm buying at a discount. Now, it is worth mentioning that a lot of people like using a margin of safety on these things, and 10% is actually very slim. A lot of investors will only invest when it's more than 10% or more than 20% on discount, or perhaps on the most extreme, some people will say, I only invest when the company is 50% undervalued, which is, I think, ridiculous, but perhaps they're not using as detailed of discounted cash flow methodology. In this case, there's not that much profit to be made, there's not that much discount, but you also have to account that I believe I've used conservative estimates. If I wanted to be more detailed, I could have come up with another estimate, because I've only given a pessimistic and a neutral estimate. I could give an optimist situation where Diablo 4 is a great success, Diablo 2 Immortal is a great success, and Diablo 2 Resurrected is a great success. For the purposes of the Value Town Fund, though, it's underpriced, which means I'll simply buy it. It's also worth mentioning that this is only underpriced when I believe that I'm willing to accept a 6.15% return on the stock, which admittedly is a little bit low. However, the beta of 0.8 represents that a company like this, an entertainment company, does not fluctuate as much as the overall market during markets' ups and downs. So less volatile than the overall market, which means I'm willing to accept a smaller return. The final bit, as I am about to go and buy the stock, I'm going to look up FinViz. Actually, this is before. This happened in between. This is the technical analysis part. I kind of think this kind of very simple technical analysis, I value technical analysis at like somewhere between 0 and 5% of the value. You can look at short-term movements and predict what the stock is going to do by reading the tea leaves. FinViz has decided to draw a horizontal line here because that seems to be what support is. It seems like it has been very difficult for the stock to go under this price. You can see it here, 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 and here. It seems like it doesn't go under that. There's also the high side, where it seems like they don't break above that. And if they do break above that, then, that's considered a really good thing. There's also the 20-day moving average, the 50-day moving average, and the 200-day moving average. Worth noting that Activision Blizzard stock has stalled for long enough that it's actually approaching the 200-day moving average. My general view on technical analysis is because people believe in technical analysis, people believe that the 200-day moving average is a support line, so therefore it's kind of a self-fulfilling prophecy. In fact, they kind of believe that the 50-day is a support line as well, and the stock moved under the 50-day support line. Whatever. Is this line support? It probably is, but again, whatever. I take this as just kind of an interesting, fascinating note. The fact that it is near support lines does make me feel a little bit better, but honestly, it doesn't even really matter to me. One of the big things coming up is I expect a fairly boring earnings report for Activision Blizzard. It is coming up very, very shortly. August 3, I think no big news has happened. And yet, this may be a catalyst for the stock to go up. Why? The analysts expect this company to make $1.9 billion. So I think Activision Blizzard will beat earnings expectations on August 3rd. And, this is an initial claim. If they don't, I'll probably adjust my price prediction. Now that might not be a surprise to anyone, and even if they beat expectations, maybe the overall investor already expected that they will beat expectations because, it's a lowball estimate from the analysts. But at the same time, there is the overarching story. Like on the grand scale, think about Activision Blizzard and think of it as a COVID play. The reason why Activision Blizzard did so well in 2020 is because people were locked up at home. The theory is that people think that the people who joined in during COVID, as the country opens again, people are going to play games less. And this is a bit of the story that you have to ask yourself. Do you believe in that? Or maybe you believe that the people that Activision Blizzard managed to capture during the COVID lockdown, they're going to keep playing games. And Call of Duty, from the Activision side, this Call of Duty Warzone game, I think it's actually pretty compelling to keep playing once you've tried it out. At the very least, according to the streaming viewership, it looks like it's holding steady. Will people just stop playing computer games when the country opens up? I think no. I think we're off for a bright future in computer gaming. So again, as a disclaimer, I did not own Activision Blizzard. Now, however, I'm going to buy it. Minor position, because it's just in the Valuetown Fund. But maybe I've made the case compelling enough that maybe even I'm interested in buying it. And welcome to Webull, the trading platform that I use for the Valuetown show. If you sign up with Webull, you and I get free stocks. That's pretty sweet. I'm going to begin by selling the free stocks that I got when I signed up. Now, thanks to the people who signed up for Patreon, even before the first airing of this episode, we've got a total of $485.92 to use. Now, on the Valuetown Fund show, I like to promote long-term investing in low-cost index funds. So given that I was funded for $480, 50% of that is going to go into index funds. That's $240. Now, 80% of that is going to VTI, 20% of that is going to VXUS. Now, on the desktop, Webull is rolling out fractional shares for the desktop. Currently not in for VTI on the desktop. However, I can do so on my mobile phone. Now, I went ahead and bought my 0.64 shares of Activision. In addition, I'm going to buy 2 more whole shares of it, which I can do on this app, on this desktop rather. And hooray! There you have it, the first trades of the Valuetown Fund. Now with just about $240 in Activision stock and about $240 in low-cost index funds. So hooray, that's Valuetown Fund Show number 1 in the books. Great one to start off with Activision Blizzard, because I do not anticipate in future Valuetown Fund shows that I will be able to as precisely predict a certain revenue increase given a game release such as Diablo 2 Resurrected or Diablo 4. If you're interested in these spreadsheets, they're going to be available for subscribers to my Patreon. Subscribe to my Patreon in order to support the Valuetown Fund Show and give me money to be able to invest in more stocks for the show. Also, by subscribing to my Patreon, you're going to be able to see more about my personal investing. YouTube is going to be able to pick the 3rd valuation that I do in this series. Go ahead and post in the comments to my reply a company with its stock ticker and a brief reason why that should be the next company evaluated. Remember that valuation is a craft and not a science, so don't just trust mine. Hopefully, though, this was enlightening to my process, and if you're so inclined and interested in investing, do your own due diligence and research.